One could argue that the RBI's commentary is pretty similar to the US Fed's commentary, talking about sticky inflation and growth in the same parlance. Like the US Fed, the RBI too is non-committal about when the pause will come in. What does it mean for banks, lending, rates, and more? Let's put that question across to Mr. Ashwini Kumar Tewari. He's the MD of State Bank of India, joins us right now in the conversation. Mr. Tewari, good having you. Thanks so much for joining in. Were you expecting the commentary to be slightly more dovish than what the RBI has signaled, or is this in line with what you estimated?
So the rate hike was on expected lines. Our in-house economic team also said similar thing. As for the commentary, we really don't speculate on what the nature of the commentary is, dovish or hawkish. I think the governor has made it clear they will be driven by data, and they will be also driven by the circumstances as they evolve. So I don't read too much into the commentary, whether there is a residual hike left and all. That those are decisions better left to the central bank. As far as we are concerned, we focus on the impact and the after effects of the hike or potential hikes in future, if any. So that's where we are focused on. I don't read too much into the language or the nuance of the language. That's not our job.
You reckon there are potential hikes in the future?
I don't know. That is up to the governor. That will be data driven. So as I said, we don't speculate on those matters.
Speculate.
This one was expected. This one was expected.
Got it. Pallavi?
Sir, I do want to ask you about another important announcement by Governor Das regarding the levying of penal charges by banks and financial institutions. What are you making of that?
So the operative word which has been used there is a wide divergence between the approaches followed by different banks. And it is not only banks, actually. I think they meant the entire spectrum of financial players, NBFCs and others included. So if you look at that, then there could be some divergences. However, as far as the banks are concerned, they are broadly aligned. The penal rates are in a particular range. What is also said is instead of a penal charge which should be levied, these are rates which get added on to the main rate. Now, as so far, these are largely in line with the terms of the contract. It's very well known to the borrower that there is an additional rate. So, for example, just to give a very simple example, in case the account goes over the limit, so there is a penal interest which is charged. It's not a penal charge, because penal charge is one time. Now, so long as the outstanding goes above the sanctioned limit, the penal interest could apply, and this gets added on to the main rate. So this is one example where I think the penal rate would be more appropriate, and the penal charge could be there where some term is, for example, breached. Some covenant is breached, there could be a penal charge. So this depends on how the individual bank's policy is. However, we'll have to wait for the discussion paper to come out to understand where the RBI is coming from. If there is a wide divergence between the players, surely there should be some range. So to that extent, we are okay. But let's look at the actual paper when it comes out.
Sure. So just to follow up on that, for the understanding of our viewers, what are the instruments that these penal charges are expected to cover?
So typically, there are on loan products, there are multiple kind of charges which could be levied. For example, one is, as I said, this is the penal interest as of now, which is the loan outstanding in a cash credit account going above the sanctioned limit. Some checks are drawn by the borrowers. That is one scenario. There could be covenants which are between the banks and the borrower, largely applicable to corporates, whereby suppose the corporate has to inform the bank of taking a borrowing from outside and he has not done so, and thereby the overall borrowing limits or the borrowing profile of the borrower has changed. Similarly, any material information which as per terms of covenants and contract should have been advised to the bank is not done. So these are areas where the banks, as per covenant terms, can levy charges. So these are some examples on the loan side. Now, coming to deposit side, there is a clause of minimum balance. Now, while we don't do so, but there are many banks which apply a minimum balance charge, that if there is let's say, 500 rupees minimum balance in a saving account and the balance falls below that, so the payment is allowed, but there is a charge on that. And that charge could be like per quarter, so many rupees. It's not a continuous kind of thing, but so long as the balance stays below minimum, this could be a charge. And so then similarly, there are limits on checks on certain accounts. For example, the basic saving banking account. And if 2 checks are allowed in a month and there are, let's say, 10 checks which are levied, then banks as per terms could levy some charges on that. Those are charges. So these are some examples of that, what the different kind of charges could be.
Will it also cover credit card charges?
So for us, we have a credit card as a separate company. It's not within the bank, but yes, a lot of banks do have that. And there's a mix of rates which are levied for, let's say, the card outstandings not being paid on time and revolving, as it is called. There it is interest rates. It's not a charge. But there is also a late payment charge, or there is a charge being not paying on time. All those things are charges. So there's a mix of rates and charges in credit card companies.
Okay, thank you. That was most helpful. Neeraj?
Yeah, Mr. Tewari, a word on how do you expect the trajectory of cost of funds to be like with the assumption? So I know you're not making an assumption, but let's assume that there is at best maybe one more hike or a pause scenario after that. But smaller banks, which are still maybe gasping for deposits compared to the larger peers, might go ahead and hike rates in a bid to attract or woo borrowers. How do you think the cost of funds trajectory could be like over the course of the next 6 months?
Yes, so there are 2-3 nuances here. One is that as part of the monetary policy transmission for the last 2 years, RBI has been nudging, and banks have been linking most of the loans to a external benchmark. Now that could be repo for some like us. It could be other parameters as well for market-based benchmarks. So as a result, most of the retail loans, housing loans, car loans, all of these loans have now become linked to the external benchmarks. So to that extent, as and when the rate hike happens like this time, or if anything happens in the future, these loans get repriced very, very quickly. And for the other loans, like for example, for us, the MCLR, which we have a significant portion, they are reset at the appropriate tenor date. So if it is a 3-month MCLR, then at the end of the 3 months of the quarter, or 6 months, depending on the tenor, these are reset. And of course, at that point of time, we will look at both the cost of funds and the yield, etc. Now, overall, if you look at, so this is one scenario where the loans anyway gets priced in as soon as the rate hike happens from the central bank. Now, to support this loan growth, and we have seen the last 2 quarters, the system as a whole has grown significantly in loans, the banking system and also the NBFCs. And therefore, to that extent, and in fact, so much so that the overall absolute growth of loans is higher than the absolute growth of deposits. So which means, like, if you have 100 rupees deposits raised, for a bank today, about 23.5 has to be set aside as a CRR, SLR, etc. And therefore, what is available to the bank is around about, let's say, 67, 68 rupees to lend as a loan. However, what we are saying today is that almost the same amount, or let's say 102 of loans as against 100 of deposits. So which means that the credit deposit ratio of banks has been going up as a result. And many of the banks you see are in 80s or some are in 90s. Now, this is not a situation which is very good in terms of stability, in terms of how the bank should look at risk and ALM risk, etc. So therefore, the pressure on deposit rates has already started. And last 2 quarters, you would have seen, while the rate hike started in May, the loan hikes, apart from the repo link, have followed with a little bit of a deposit hikes, followed with a little bit of a lag. But in the last 2 quarters, and last quarter especially, this has really bumped up, and banks are now hiking more. In fact, I would argue that the last quarter, or maybe the current period, deposit hikes have been higher than the loan hikes in the banks, some of the banks at least. So that clearly tells us that there is a pressure on deposit gathering. And the alternates which are available in terms of borrowing, apart from the short-term borrowing and external borrowing, all of those rates have gone up. So the bonds for corporates as also for banks, all the rates have moved up. And therefore, there is no respite outside this system. And as a result, most banks are now focused on gathering more deposits, especially CASA, and ensure they will have to pay for higher deposit growth, whichever is needed. So in that sense, it's good for the savers, ultimately.
Yeah, but my main question is, do you reckon it stays higher for longer, considering the fact that the RBI policy statement doesn't talk about a pause in any fashion whatsoever? Neither does the Fed, but nor does the RBI.
So obviously, we can't speculate on what the rate movement in central banks going forward is. But one general thing is that loan rates get repriced very quickly because they are mostly linked to external benchmarks, etc., apart from MCLR. Whereas the deposit rates are hiked in response to these rates.
Sure.
And since the bulk of the deposit still for most banks is the fixed deposit rate, if the saver is getting higher rate, they will not prepay it. They will allow it to go to maturity. So the reduction in deposit rates happens with a lot of lag. And to that extent, therefore, what you're seeing today in the cost of funds, that was the original question, I think this will move up with a lag. And once it moves up, it won't come down even if the rates start to come down. That's the pattern we always see, and that's going to happen this time as well.
Got it. Pallavi, any last question?
So just following up on your comments on the credit growth, deposit growth skew for the system as a whole, considering you said that now the scenario is looking a little better, what's the outlook like, especially considering liquidity and the RBI's continuing stance on withdrawal of liquidity, posing additional concerns? What's the outlook looking like on the credit and deposit growth front?
So as I said, the credit growth has been strong, and this is growth as a result of multiple factors. One, of course, is that the economy is doing well, and as you know, we are one of the few large economies doing well. And if this 6% to 7% range, if this continues, and more and more industries continue to grow, and this is when the capacity utilization is still in the 70s. I mean, the number I think given was 74.5 or thereabouts. So as new investments start to happen, alternate sources today for corporates outside India, which is dollar borrowing, etc., have become more expensive. And therefore, the corporates, which were the corporate books, which was not growing fast in the last till 2 quarters before, has started growing now as a result of the alternate sources drying up. The bond costs have gone up. So therefore, everybody is now coming back to the banks. And as they do so, and the economy itself grows, so you have both the overall growth effect from the economy side, as also the shifting of sources of borrowing from the corporates back to the banks. So as a result of all this, there is definitely the loan growth, in my view, will continue to be strong for the next couple of quarters. If that continues and the deposit growth trails behind, as it has happened in the last two quarters, there will be pressure on the cost of funds. There will also be overall going forward a pressure on NIMs, though you would have seen the NIMs have actually improved in the last couple of quarters because the loan rates are ahead of the deposit rate growth. But this is going to reverse, and this is going to normalize in the next couple of quarters, where NIMs will again revert back to the normal mean which most banks have, because the deposit rates are going to catch up as we go forward. So that's the overall scenario in my view. Rate movement upwards for deposits surely will happen. Of loan rates, what has happened. This will get passed on. Whether it will happen further, I don't know, because that depends on the central bank and the demand and supply in the market.
Got it. Mr. Tewari, lovely talking to you today. Thank you so much for taking the time out, and have a great remainder of 2023.
Thank you, Neeraj. Thank you, Pallavi.
Thank you.
The pleasure was ours. Viewers, thanks for tuning in.